What's up, guys? I'm Nobody Special. And as we speak, the bond market is at an important inflection point, and where it goes over the next few days, possibly even hours, could dictate the direction of things like the stock market, precious metals, and real estate. We're going to talk about the key levels to watch and talk about what would happen if it goes one way or the other. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special. And interest rates on the benchmark U.S. 10-year Treasury are right in this inflection point right now, and the direction it goes from here could dictate the direction of pretty much the entire economy. Now, before we get into the numbers, if you guys wouldn't mind doing me a favor and smashing that beautiful like button, subscribing to my channel, hitting that notification bell, I would be forever in your debt. Now let's get into the numbers. Now, the interest rate on the 10-year started the year just below 1%, and from January to March, it seemed like they were on an escalator, going straight up from there, peaking at about 1.75%. Now, if you recall, I did a video a couple of weeks ago about the bond market sending us signals back in March, in particular around the key dates of March 18th and March 31st, centering around the supplementary leverage ratio expiration. On March 18th, the Fed announced they were going to let the exemption to the SLR expire, and then on March 31st, it actually did expire. And in that video, I talked about how interest rates on the 10-year had formed this double top at that point and then reversed. And from March until pretty much the end of July, we saw those interest rates were coming back down. Now, the reason for that I got into in that other video. The supplementary leverage ratio is basically the rule that says banks need to have so much collateral on their books for all of the amount of liabilities. Now, for banks, our money is liabilities. And there is record amounts of our money in the banks because of all the stimmies and the child care tax credits and everything else. So the banks have been starved for collateral. On top of this, the federal government has been spending down the Treasury general account, so they haven't been issuing new collateral. And this has resulted in basically this reverse repo crisis that we've all been talking about for the last few months, as banks make these massive loans to the Fed overnight for peanuts in exchange to hold collateral. And recently, that topped out at over $1 trillion. Yesterday, it was $1,086 billion in these overnight loans that the banks made to the Fed. So the banks are still swimming in liquidity. However, in the last couple of days or the last 2 weeks or so, we've seen interest rates have really climbed. Now, they bottomed out at about 1.15% or 1.17%. And it looked like it formed something of a double bottom before these rates started coming up. But if you look close at the chart, you can see we're at this pivotal moment. And let's get into those numbers now. All right, so here we are looking at the yield on the 10-year Treasury. Now, just for a little bit of review, here's where we said at the beginning of the year. We started over here around 95 or 0.95%. And as you can see, throughout the beginning of the year, we pretty much took the escalator straight up here. Now, over here is that double top that I described to you guys in my previous video. Here's March 18th, the day they announced that the supplementary leverage ratio exemption was not going to be extended. And then here's the 31st, the day that the SLR actually expired. And that was really the beginning of the reverse repo situation. And you can see interest rates have pretty much come straight down ever since. Now, I have these two trend lines here. I want you to pay close attention to those. The purple line, the one with more of a curve to it, that is your 50-day simple moving average. And the red line, the one that's a little smoother, that's your 200-day moving average. Now, for all the technical analysis wizardry that's out there, these are really your two most important technical levels. I mean, you could do TA until the cows come home, but if you want to keep things simple, start with the 50 and the 200 line. Now, you can see we came down pretty far, and then it looks like we almost put in something of a double bottom here. Now, I was very weary of that, so I went back to these 2 days when we were down around 1.18, 1.17, and, intraday, both of those went down to about 1.15. And I was looking in the headlines, and there really wasn't all that much. I mean, on 20th of July was when the fears of the Delta variant on the 19th and the 20th, that's when that really became like front page news. That's when everybody started rolling their eyes. Oh, my God, more lockdowns again. And that was the day the market had a pretty violent sell-off that reversed pretty quickly. So that's what happened on that day. Again, I don't think that's earth-shattering, market-moving news, though. And then the next day it bottomed out was right here at the beginning of August. Now, the headlines on those days, that was the debt ceiling exemption expiring. So it's possible those two events, the Delta variant and the debt ceiling expiration, or the debt ceiling being reinstated, that those could have been turning points in the market. Because if you notice, after that double bottom, we've come up pretty fast. I mean, we had 5 straight days of increases in the bond yields. Now remember, bond yields going up, that's bond prices coming down. But you'll notice we came up. I mean, let's zoom in a little bit here. Hold on, I'm going to have to move myself. The feedback on one of my last videos, I was blocking the chart. So if we look here very closely at these few days, you notice, look at that. We came up, and I mean, we just kissed that 50-day line right on the nose and stopped. I mean, we came right up to the 50-day moving average. And then we reversed lower. And now here we are today, and we came straight down, and look at that. We just kissed right on the nose that 200-day line, which is at about 1.31 or 1.30. So these two lines are converging right now, and the direction bond yields go from here could really dictate where the whole economy goes. If we break above this 50-day line, all right, then that signals, to me at least, that this double bottom was for real, and that this trend since March with the SLR expiring, that trend is over, and that we're heading back up from there. And a lot of analysts had been calling for yields to end the year at about 2%. So if we break out of this downtrend, if we go above the 50-day moving average on the yields and keep going higher from there, then we're heading to that 2% number between now and the end of the year. That would be very bearish for precious metals. That would be very bearish for the real estate market. And in my opinion, I think if we get anywhere near that 2% level on the 10-year, I think stocks are going to sell off big time. So that's important to watch that 50-day moving average. If that line doesn't hold, if we break above it, then in my opinion, there's bad news on the horizon. Just my opinion. Now, if we break below it, if we break below this 200-day line, that's another big one, because that tells me that this downtrend, let's move me, I'm in the way again. I'm coming over here. If we break below this 200-day moving average, which we're threatening to do today, I mean, we're right there, then that tells me that this downtrend since March is still intact. And if that's the case, then we're heading lower. We're heading lower, down like around 1%, possibly even below where we started the year. And that will continue right up until this debt ceiling issue comes to front and center, because that's still out there, and that's sometime around October. So, I mean, we're in this very narrow band right now between this 50 and this 200-day line. We could go either way, but the next few days in the bond market, in my opinion, are going to be vital, very important in the direction of the whole economy. Now, one of the reasons why I'm still leaning towards we go lower from here in yields is because of the reverse repo crisis. Let's bring up the St. Louis Fed, because if we zoom in on this reverse repo crisis, now this is going back until, let's move me again. I'm always in the way. Get my mug out of your way. So this is pretty much over that same time horizon since that top in yields in March. And if you look at this reverse repo crisis, I mean, I don't know if we need to call it a crisis. I mean, I don't think this is really hurting anything. I mean, maybe a more talented economist could say otherwise. But I don't see this reverse repo doing damage. But I do see it signaling that the excess liquidity and the shortage of collateral is still in play. Because we just peaked yesterday. I mean, we have a new number coming out in a couple of minutes now. But we peaked yesterday at $1,087 billion of cash was loaned to the Fed overnight in exchange for collateral, i.e. treasury bonds. So financial institutions are still starved for treasury bonds. They're starving for collateral, and they're loaning huge sums of money to the Fed to get it. That tells me there is still plenty of demand for these bonds. And if there's plenty of demand for these bonds, those bond prices are going to resume moving upward, and those yields are going to resume coming down. I see this trend in the 10-year interest rate continuing down as long as I see this trend in the reverse repo continuing up. And I expect the trend in reverse repos to continue up well into October. So as you can see in that chart, those pivotal levels of 1.38 and 1.30 are the two levels to watch. Now we've bumped up against the 1.38 and we came back down, and now we're butting down below up against the 1.30. Which way it goes from here is going to dictate a lot of things. Keep in mind, interest rates is pretty much what dictates the economy. Lower interest rates means cheaper mortgages. Cheaper mortgages means higher housing prices. So the yield on the 10-year is going to affect the housing market. Lower interest rates and high inflation means lower real yields, which means higher precious metal prices. So if the interest rates keep going down, we could see higher precious metal prices. And of course, cheap money is good for the stock market. It lets people go out on margin and buy stocks. It lets companies that don't make a lot of money borrow and keep their operations flowing. Now, the flip side of that coin, if those interest rates reverse and they start climbing up, we could see an end to this massive run we've had in real estate. We could see further pressure on precious metal prices, and we could see some real worries in the stock market develop. So I want you guys to watch that critical yield on the 10-year interest rate over the next couple of days next week. So which way do you think interest rates are going to go from here? Let me know down in the comments. Place your bets, folks. There's absolutely nothing riding on it except bragging rights. My bet, if I had to guess, I would say rates are going lower from here. But that's just me. You let me know what you think. Guys, I want to thank you for your time. I hope you enjoyed this video. Please give me a thumbs up, subscribe to my channel, and hit that notification bell. It would really help me out. In the meantime, live small and dream big.